Welcome to the Halo Effect, Hospitality Stories with Ashley and Michael Donald. Hospitality isn't just our profession, it's our passion. With decades of experience and countless stories to share, we've navigated the highs and lows of this dynamic industry, not just as professionals, but as a husband and wife team tackling the challenges of business and life together. This podcast is your invitation to step behind the curtain of the hospitality world. We'll share real experiences, lessons learned, and the moments that have shaped our journey, offering inspiration and insights for anyone walking a similar path. Whether you're just starting out or have years under your belt, we're here to remind you that every challenge is an opportunity and every story has the power to inspire. Hello and welcome to the Halo Effect, Hospitality Stories with Ashley and Michael Donald. This week, IHIF Berlin is taking place. There's lots of conversation around investment, performance, deal activity and what success really looks like in today's market. And while RevPAR still dominates many of those conversations, today we want to look at the bigger picture because strong trading performance does not always translate into strong owner returns. And that gap really feels more important than ever right now.
Absolutely. So this week also marks the launch of the very first InnSights White Paper from Accommodate Consulting and In Practice. The white paper returns Beyond RevPAR, explores why RevPAR on its own is no longer enough and explores what owners, investors and operators should really be paying attention to instead. So to help us unpack all of this, we're joined by two guests, representatives from both In Practice and Accommodate Consulting. So firstly, let's welcome Graham Norris, co-founder of In Practice. Good morning, Graham. How are you?
Morning, Ashley. Morning, Michael. How are you?
Very good. Great to have you here. Perhaps if you can just give us a quick summary and remind our listeners, you're almost a regular on here now, Graham, but just remind our listeners a summary of In Practice.
Yeah, I mean, In Practice is a new operating platform which we set up last year. And the intention really is to give owners a much more aligned service. What we see in the market, having worked in two of them myself, is that the big franchisees now are becoming too big and too inflexible to give a really detailed service to owners that they really need. Yeah. And therefore, we feel like we've got a little bit of a niche in the market where we can really give fantastic high-level aligned service to owners for their asset or assets. And the other slight difference with us is we're working in a partnership model with selected number of real experts to give a holistic approach and a full service to these owners should they require it. And one of the partners that we're very delighted to be linked up with is Matt at Accommodate Consulting.
Fantastic. Well, that seems like a great time to bring Matt in to introduce himself and a little bit more about Accommodate Consulting and the partnership within Practice.
Oh, well, thanks, guys. It's lovely to be back here again. And for those that I don't know, I'm Matt Hughes, founder of Accommodate Consulting. I work with hotel owners and investors on performance and capital strategy. And InnSights is really a collaboration within Practice, looking at how that translates into actual returns. So great to be with you here today to talk it through.
InnSights White Paper launched earlier this week in time with IHIF. So we'd love to, really kind of get in and unpack, what's been happening. Maybe please share anything that's of note that you've seen from IHIF. But let's delve into what we're calling the RevPAR problem. Maybe we'll come to Matt first. So, walk us through with the white paper, when you say RevPAR is a trading metric, not a return metric.
Yeah, well, look, a lot of the conversations in hospitality start with performance, occupancy, rate, RevPAR, and that's great. When you have all the big CEOs, the big branding companies, Bloomberg or so on and so forth, so RevPAR is always this vanity metric, and it's really important. But the missing piece is what that actually means for cash and returns, because the same asset can look strong on paper but behave very differently financially. And that's the reality. So that disconnect feels more visible now, particularly with so many financial changes. We're living in this crazy world of volatility where that has become the norm.
Yeah, absolutely. And Graham, from your perspective, you've sat across the table from many hotel owners navigating this. What's your take and experience of sort of being in the room and having those conversations?
Well, I agree with Matt completely. I mean, what I've seen in a lot of this is that often the reviews that you have with owners and asset managers are what you would call trading reviews. And in many cases, the operating side of the arrangement doesn't actually get to see the structural side of the arrangement. So they don't know what the covenant tests are, for example. They don't know how much debt the ownership is carrying. They don't know what the interest payments are. So very often we're talking in terms of occupancy average rate, RevPAR, TrevPAR, because those are the things that are understood from a trading perspective, but they don't tell the real story.
Yeah.
In any case, RevPAR has been long recognised as, a sort of a vanity metric, I think, as Matt put it. The reality is, depending on the type of hotel you have, from a revenue perspective, actually TrevPAR is the key one.
Yeah.
In conjunction with RGI or hot stats penetration. And for me, GOP par is the only real operating metric that you should be focused on.
So is that if you had to sort of single out one particular thing, would that be the sort of biggest blind spot you see in how hotel performance gets reported right now?
Yeah, I'll give you an example of a live hotel that I was responsible for some time ago. It was a 5-star hotel which had a Michelin star restaurant and a beautiful spa, but in a very seasonal market. And the management team there had decided that because they were a 5-star hotel, they had to protect rate at all costs. So their only fixation was on RevPAR. And they were losing money. They were losing a fortune, actually. We made one small strategy change, which was actually we should be less worried about average rate in the off-season because we should be focused on TrevPAR to get people as an entry level into the Michelin star restaurant and get them into the spa. And we turned that hotel around from loss making to making significant profit in 1 year simply by focusing on the right thing.
Yeah.
100%. I echo that. And I don't know whether there's an underlying fact here. The big brand companies have a part to play here because the rhetoric is top line. Because it's about revenue, because that's how they make their fees. Gross rooms revenue is on revenue. But if you're just driving revenue and your flow through is really poor, then nobody, well, the owners certainly don't win. The branding companies, the franchisor will be absolutely fine. So there's this over-reliance on top-line metrics, this lack of connection to cash flow, because that's where the real capital decisions are made. And the reporting, in the reality, the reporting doesn't often reflect the decisions the owner actually makes. And sometimes they can be a lag on reporting. It could be that their real-time reporting is not, the owners are not seeing the correct data for a month after it's happened, by which time it's kind of obsolete. So, there's an opportunity in the technology space for the future as well.
Yeah, absolutely. I think that's both great examples of just, as you say, that sort of holistic approach and connecting, top line and bottom line reporting. So you're seeing the full picture and being able to make an informed decision with almost real time reporting and being a sort of a necessity, as you say, rather than it being, a month behind, in which time the market may have moved on.
Yeah, it really complements sort of my experience of working in operations where it was focused on revenue. And yes, of course, we'd have a monthly meeting that we would look back at the results that took place maybe 6 weeks ago in terms of costs and things and where we could potentially save those costs. But it was already way too late. We've spent the money already. We've already committed to it, right? And it's very hard to have much of an impact then.
But and I think just as you say, from an operator's perspective, I think it's that communication and that alignment of, what is the scorecard across the all of the stakeholders, from an owner investor perspective to the operators to the team on the ground as well. And I think so everyone is very aligned, because you can have sort of quite siloed decision making potentially that flows right the way through to the operating part of the hotel.
Yeah, I love you've brought that up, because it is about misalignment. So many decisions in hotels are made in silos. You have commercial here, you have operations, you have finance, and they're all talking different languages. There's a misalignment in incentives and KPIs of what actually matters to the owners.
True. Graham, you mentioned the borrowing rates, and the Bank of England has been on a bit of a base rate journey over the last few years. It was down to record lows, and then it went up quite dramatically, up to 5.25% in just a few years. It's back down now, but who knows for how long. It was supposed to go down again, and then it held, and now we don't know what's going on. Matt, how has it sort of changed the way you look at a hotel investment? How has it changed your perspective and owners' perspectives?
Well, it's great to see it on the graph there, because you see the hurdle rate moved, and that's the key. The same RevPAR can bring very different equity outcomes. Your debt service now materially impacts cash yields, and the focus shifts from growth, which is where you want it to be at this stage in your asset's life cycle, to actually just, resilience and coverage, which is... It really has a massive impact. The landscape has shifted and continues to shift.
Yeah. And Graham, from your perspective, when you're speaking to owners, that base rate change and what it does to their returns, is that something that they're very aware of, or is that something, I suppose, that you need to kind of talk them through that narrative as well?
Yeah, I mean, I would say they're all very aware of it. And in the circumstances where actually there's full alignment, so, I can think of a couple of examples where we were 100% clear both ways about, what the covenant hurdles were, what the interest rates were, what the outstanding debt was, what the cash flow position was, then each other can help make the right decisions. I think it's also about timing, because we are sort of expecting to see there's a wave of refinancing due right now, coming out of arrangements which were probably made when the interest rates were a little bit lower. And I think that is going to potentially create a lot of opportunities in the market for acquisitions, operator and brand changes, because people can't refinance at the higher level. So I think they are aware of it. Certainly the most proactive owners that I've worked with, we spoke earlier about how to pivot, what the strategy should be going forward to protect the cash flow. And of course, there's sort of two standard rules of ways of going. One is to rip the cost out of everything and minimize the cost, which is usually a very damaging way to do, because you can make a short-term impact but a long-term problem. And then some of the more enlightened owners we work with actually said, well, actually, everybody else is going to be doing that, so why don't we protect the resources we have? If anything, potentially step it up. I.e., when I say resources, I mean sales resources or whatever, and step up our activity to take advantage of what other people are doing. So, I've seen that in a couple of examples, which was very, very positive thing to do, and it worked. Yeah. Also, the very clever owners we've worked with in the past took advantage of the downturns in the markets to time the CapEx. So I can think of one hotel particularly where the owners decided to use the downtime around COVID to bring forward a significant CapEx plan that was going to be 2 years later. So they took advantage of that, where it was they could get more realistic pricing because contractors were desperate to do the work, and the hotels were not busy. they were either partially shut or shut. So yeah, the clever ones,
Yeah.
they think about it properly. But
Yeah, and
unfortunately, there's a lot of owners who are not hoteliers, and therefore the only things they understand are these basic metrics like RevPAR, and they're often making wrong decisions. Yeah.
That's a really great example, as you say, and I think a proven example of when you almost double down on that sales comms activity. You and as you say, we saw it in COVID. The brands that continued to drive activity forward, whether that was through refurbishments, different initiatives, and were present in the marketplace and didn't just kind of cut costs and go dark, were the ones that really owned the upswing when the market returned, and performed and outperformed those brands that often went a little bit quiet and had maybe lost a lot of their great team members and had to really rebuild and earn that trust again. So I think that's a really timely reminder, particularly as we are in a time of uncertainty, shall we say, at the moment.
I think it really flows through to the sort of total value framework that you talk about, Matt, in the white paper. You talk about cash today, value tomorrow, resilience. Can you talk us through that a little bit?
Yeah, and that's it. And it's not meant to be complicated. I always try to look through everything with a clarity lens. So let's break it into 3 simple questions. What cash does your asset produce today? What might it be worth tomorrow? And what happens if things go wrong? So RevPAR feeds in, sure, but that's only one input, and owners need all 3 to make decisions. That's it. Simple.
Love it, and it's really visualised very clearly in the white paper, which we'll link up in our show notes as well for our listeners to download. And Graham, from your perspective and working across many different hotels and portfolios on the cash piece today, what do you see are the biggest sort of leakage points between RevPAR and the distributable cash that you see most consistently?
Well, the key things are, not surprisingly, payroll, food and beverage margins, utility costs, and the like. And I, even now, I'm surprised. We've all been through COVID. We all went through the 2008-2009 crash. Having survived both of those things and pivoted in the business to protect cash flow and survive and keep going, I still see hotels where they're simply not paying enough attention to the detail in the P&L. We came across some hotels recently that brand new hotels with what I would consider to be a very good operator, certainly from reputation. Yet looking at the P&Ls, their food and beverage departments are losing money. Their F&B payroll was something like 73% of F&B. So they're losing money. You should not be losing money in that sort of environment. So it amazes me, even now, having been through COVID and the previous issues and all the hurdles and challenges we've had, that there's still not enough focus on the detail.
And if you don't have that in order at the good times, it's going to be impossible to then pivot and be in control in the bad times, when it gets really hard.
No, exactly. These days, there's even less of an excuse to get it wrong, because you can use technology to help you protect the resources you need. So, AI, for example, and contactless ordering and payment allow the transactional stuff to be done seamlessly and consistently with the people that you do have to do the hospitality, right? So it's easier, it should be easier to keep your margins and your KPIs in line, notwithstanding the fact that we're constantly under pressure. I mean, obviously this year, before what's been going on the last couple of weeks, everybody was expecting a big hit because business rates are jumping this year, next month. Obviously now we're probably going to see interest rates rise 2 or 3 times this year again. Utility costs are going to go through the roof again, and that will all have a knock-on effect. And just as we were seemingly coming out of that, we probably got another wave of shock. So the people that have got their total focus on every single detail of every single line of the P&L to drive sustainable NOI are the ones that will come out of this doing well.
And Matt, your thoughts on this as well? Is that what you're seeing when you're speaking with hotel owners, operators, that forensic focus?
Yes, there is, and Graham has encapsulated the key operational elements, be it labour, be it energy, departmental margins. The big ones for me would be the elements that are agreed before pen goes to paper. So that would be your fees and how that's structured, whether there is a ramp, CapEx timing. CapEx is essential because it protects your optionality of your asset. It's not something that you can avoid. It's not something you can put off. But by having strong relationships with your lender, with your franchisor, you can negotiate timing of that CapEx investment. And I think that's critical because those are big pieces.
This, I suppose, both to Matt and to Graham. London ADR is running nearly £30 ahead of regional England at the moment. Does that framework look different depending on where your asset sits? I mean, even if you're looking outside of the UK?
I think the attention to detail of knowing where the value of your asset today, tomorrow, in the future works across the board. Of course, the UK is a very mature hotel market and the operators are extremely savvy and they're looking at every detail, and it creates highly competitive environments. So if people aren't looking at those details, there's a major problem. Yes, in the less mature markets, maybe there's not the attention and there's bigger opportunities to save margin, but it works across the board. It really does.
Yeah, Graham. And Graham, you're seeing something similar across. I know you have, working with owners kind of outside of London, Edinburgh, particularly buoyant at the moment. Is that what you're seeing as well from your side?
Yeah, absolutely. I mean, the old adage, location. It's no surprise that the average rates are higher in London, but so are the costs in London.
Yeah.
And obviously the cost of property and land are much higher in London, of course, and therefore everything is relative, isn't it? But exactly as Matt said, it's the same across the board. Obviously, if you have a tertiary location, it's much harder to make sustainable NOI in a downturn than it is in a primary location, and also depending on what structure you have, whether it's a lease or a franchise or a management agreement with a brand, those things also have an impact in terms of how you can drive sustainable NOI.
Staying with that point, Graham, when you are advising an owner on structure, whether that be lease, management, contract, franchise, what's the question they should be asking that they potentially aren't, or how would you kind of go about advising them to make an informed decision?
Well, that's one of the things we do all the time is talk to an owner about the opportunities. I'm dealing with something at the moment which is an apart hotel project in the northwest. The owner is unsure as to whether it should be branded or unbranded. He's not a new hotelier, he's done hotels before. And very often people will make snap decisions about, I don't think we should brand this because of the brand fees are expensive. But they fail to understand what you need to replace that with to drive the same bottom line.
Yeah.
And in certain markets, if you pick the right brand, that protects you somewhat against downturns. I would always use this as an example that you talk about the big brands like Marriott, Hilton, IHG. All three of them have got extremely powerful loyalty schemes, and in my mind, those are the things which protect you in a downturn because, So, in the respect of the example I gave you, we are recommending that they go branded. Actually, it's a Marriott brand that we're recommending because of the powerful nature of the distribution engine and how strong the loyalty scheme is. Bearing in mind the city that the hotel's going in is incredibly competitive,
Right, yeah.
Possibly oversupplied. So, but it depends. Depends on location.
Exactly, and that Bonvoy loyalty program from Marriott is particularly powerful, and I think has, as you say, that distribution and is helps to build that resilience, as you say. Matt, you'll be familiar with the Bonvoy program, I'm sure. From your perspective, is that similar conversations you're having with owners and when you're advising on structure?
I tend to step back a little bit. I always bring it back to motivations and expectations. You can't get emotional about these things because a brand over the door does not guarantee success. There's a lot of work that you've got to do yourself. It comes back to what you want to do with that asset. Are you going to keep that for the next 20, 30 years and pass it on to your children? Or are you going to try and sell it after 5 years? If you're going to try and sell it after 5 years, yes, a brand will give you security in terms of distribution systems. It will protect your optionality because of the brand standards. But are you going to be tied in to not being able to sell that? It depends what you agree in your contract and so on. So, it's coming back to the contractual and context of that hotel and what you want to get out of it when you exit.
So in 2025, UK hotel investment was about £5 billion. Transaction volume was obviously huge, a really good year. What does transaction volume tell you? Is it anything meaningful about where the market is actually heading now? Or is it always at risk and always on a bit of a roller coaster?
It's a proxy for liquidity and confidence, for sure. The market is changing because I was speaking to somebody about this the other day. None of us got crystal balls, but if you had to underwrite a project, 5 years ago, 6 years ago, there's no one on this planet who could have predicted the volatility that we've been faced and continue to face. What you're seeing on the back of that now is lower volumes, tighter underwriting. And with underwriting as well, there's always this assumption that you're going to have stability at one point. You look at your projections, your pro forma, okay, we're going to stabilize in year 3 or year 5. In all reality, that isn't the reality anymore. And you've got to, you've got to stress test your asset from many different elements and continue to do that. The impacts of that being, your exit on your optionality, your pricing, and all of that will have to feed and does feed in directly how your assets are managed today. And obviously that's where Graham and in practice strength is.
What was your feeling on that, Graham, in terms of transaction volume at the moment and where the market is heading?
Yeah, don't forget that in 2025, a big chunk of that transaction volume in the UK was two big transactions.
Yeah.
One being the Pandox, one for Delata, and one being the Amanti one.
Yeah.
What we saw in the rest of the market in the UK was very slow movement on sort of individual assets. There was some moving. We've come across a lot of opportunities where there's a hotel available for purchase. It's got a repositioning angle. It's got an asset management angle. Therefore, it's got some interest. And more often than not, what we saw was that there was still a big gap between owners' expectation in terms of price and actual value. So many of those transactions didn't take place. And I think that is still the case. It's relatively slow in the sort of middle of the market, other than the very big headline deals that were done last year. You see quite a lot of smaller, I've noticed 1 or 2 country house hotels being sold. What we're seeing now is as well, there's a sort of generational element to this where families who've owned properties for 30 years either don't have children to pass it on to, or the children aren't interested in the business, and therefore those are coming to the market now. But generally, I think, notwithstanding that interest rates have eased, hopefully they'll stay eased, but there's still this gap between owner expectation and actual value. Yeah, I saw one example last week where the sort of talk, the asking price for this particular hotel, the owner was wanting the purchaser to pay up all the forward value in his favour. And actually the hotel was only worth about half of what the asking price was. So, no one's going to do that, are they? And except for vanity purchases, or long-term ownership in London or something. But so I think it'll still be relatively slow. And what we know is the uncertainty of what's going on at the moment will always create risks and opportunities. So there may well be opportunities coming out of it. And of course, one of the opportunities we can see immediately is staycation business may go up again.
Well, it's been fantastic to have you on just to really unpack some of the key themes in the white paper. There's so much in the white paper. It's the first of hoping to run them quarterly with obviously the kind of continued changes in the marketplace. But I think it really highlights that partnership of in practice and Accommodate Consulting, bringing together your skills and experience and really providing that agile and flexible services for hotel owners and operators. So thank you both so much for your time. I'm really grateful for you taking time out to discuss the white paper, which launched this week. As I say, we'll ensure that it's all linked up in the show notes. There's lots of social media posts on In Practice and Accommodate Consulting's channels, websites, so please do go and check them out. And if you'd like to get in touch with Graham or Matt, their details will be linked up in the notes as well. So thank you both so much.
Thank you, Matt. Thank you, Graham.
Thank you both.
Thank you,
Always
Matt.
a pleasure.
Thank you for listening to The Halo Effect, Hospitality Stories with Ashley and Michael Donald. We hope today's episode has offered some insights and encouragement to anyone navigating the world of hospitality or entrepreneurship. We'd love to hear from you. If you have a question, want to suggest a topic, or interested in just joining us as a guest, you'll find our contact details in the show notes. Don't forget to follow, like, or subscribe to The Halo Effect on your favourite podcast platform so you never miss an episode. Until next time, thank you, and we can't wait to welcome you back for more stories and inspiration.